All traders, welcome back to this series of educational videos that FXCM has for you. My name is David Londoño. I'm a trader and I also do market analysis. And I know how much you love to know about different strategies. So today we're going to be talking about hedging strategies with CFDs or with contracts for difference, okay? That's what CFD stands for. This is a strategy that allows traders to protect their portfolios against unfavorable market movements without needing to sell their existing holdings. So CFDs are derivative products that let you speculate on the price movements of an underlying asset without owning it directly or making them a flexible and popular hedging tool. So let's just start talking about why hedge with CFDs, okay? Particularly appealing because it allows traders to, first of all, mitigate risk, which we always want to achieve, right? So protect against adverse price movements in stocks, commodities, currencies, or any other asset. Second, for leverage. CFDs are typically traded on margin, so you can hedge with a smaller capital outlay. Third, we have the profit in both directions, so you can take short positions to profit from falling prices, which is key for hedging itself. And finally, it helps us to diversify hedging, hedge a wide range of assets, including indices, stocks, commodities, and even Forex. So I wanted to give you two of the most popular and common hedging strategies with CFDs. Let's start talking about shorting the asset to hedge long position. So this is the most straightforward hedging strategy using CFDs that you can find. So if you hold a long position in an asset and anticipate a temporary decline, you can open a short CFD position on that asset to protect your portfolio. For example, you own a 10,000 worth of Apple. You have the shares and you expect a short-term downturn. You don't expect Apple to disappear, but you're expecting a downtrend on it. So to hedge, you open a short CFD position on Apple with a similar value. So if Apple's shares price drops, the loss in your stock portfolio is offset by the gain in the CFD short position. Is that understandable? It's very simple. You're hedging your position, in this case, Apple, and you're protecting it with shorting it with the CFD. Another strategy very common is the hedging a portfolio with index CFDs, okay? So instead of hedging individual stocks, traders often hedge their entire stock portfolio with index CFDs. So this is particularly useful in the trader expects market-wide risk. For example, a financial crisis or, unfortunately, geopolitical events as we are facing right now. So for example, you have a diversified stock portfolio worth on 50,000, right? And you expect the overall stock market to fall. So you short a CFD on an index like S&P 500, correlating with your portfolio's value. So if the market declines, the value of the portfolio decreases, but the short position in the index CFD gains value, offsetting your losses. So it's like the same as the shorting the asset, but this is for not individual stocks. Instead of hedging the individual stock trader, we can hedge our entire stock portfolio with the index. Those are very powerful tools or strategies. If you have a portfolio, you can use them to try to protect yourself and your investments. I would definitely recommend you to deep dive into this. It's very important for the long-term career we're looking for. And well, that will be all for this video. I hope you liked it. If it was like that, don't forget to share and subscribe. And I will see you on the next trading session.